Hello and welcome to this week's Fit Finance Sessions with myself, Tom Senegals, Henry Elliston and Tim Webb. And if you were listening last week, you would have heard us talking about GameStop and AMC and a load of other so-called meme stocks. If you'd have invested on that basis of joining on the bandwagon, you'd be down probably 50% right now. But if you have gains elsewhere in your portfolio and you're not in an ISA or a pension, we're going to talk about some of the things that you can be doing. So, Henry, Tim, if you've got gains in your portfolio, what do you need to be thinking about, and what are the sort of steps you can take?
Who's going to go first? Well, I'll start. The first thing we're talking about here, Tom, is we're talking about capital gains, obviously. And so it's important to recognise that at the moment, every man, woman, and child in the country has a capital gains tax allowance of £12,300, and they have that every year. So every year you can make £12,300 of profit on an investment. And you don't have to pay any tax on making that profit. And it's a use it or lose it tax. So you either use it this year, and that's great, and you can recycle your profit. But if you don't use it, you don't get to use it again next year. So although you do get the same allowance next year, but it doesn't become cumulative. So it's a really valuable tool, being able to use it to take profits from a portfolio as it grows and to rebalance the initial purchase cost of a portfolio. Of course, it's quite tricky when you look at larger assets. It's one of the reasons why property is a bit tricky, because you can't just sell a portion of a property, but rather you have to sell the whole lot. So your profits people tend to make on property use all of their CGT allowance for a given year, and they go well above it, although they may not then make any further gains in the future years, because they've still got their they haven't got a property any longer. I don't know, Tim, if you want to go down to the nitty gritty of how you can use the CGT allowance within a portfolio.
Yeah, definitely. So, I suppose just starting on the potential negative side effects of not doing so, something which we see more often than not, unfortunately, is people not using this allowance each tax year. And so if you've got a taxable portfolio which you're not, let's say, breaking down the gains each tax year, over time you can build up a pregnant gain, so as and when, or a big gain in there, big pregnant gain as it's called in the industry. So as and when you do want to start taking some money out, then you're over and above that CGT allowance that Henry's mentioned, then there's going to be some tax to pay. So what, of course, we're talking about is something called CGT harvesting. So essentially, without going into the finer detail, it's the process of selling down a proportion of your taxable pot for the end of the tax year, so as to only crystallise a capital gain that's going to use up your allowance. So if you've got a £20,000 gain that you've made in the portfolio, you'd only sell a couple of slices of it in whatever fashion is decided best, to crystallise 12,300 of it, because of course any more than that and you create yourself some tax. Now there is a rule in place whereby you can't just almost click your fingers once and then twice and be straight sort of sold, go straight back into the same assets that you sold. So you do have to be out of them for a 30-day period. So you'd sell out of the assets that you're in, go into very similar type of funds for 30 days and then switch straight back in there. But by doing so, as Henry said, it's use it or lose it. You're using that £12,300 allowance and then leaving, allowing your portfolio to continue to grow. Not tax-free, but a section of it would be tax-free moving forward. So it's a process which is or should be done each year, just to sort of slice down any large gains that you either got already, or if you're starting investing or you're starting the pot, then at least you prevent yourself from having a big gains build up over time.
And I think that's, like Henry was saying, with a portfolio you can chip away at those gains every time, whereas with the property you're paying all of that gain in 1 year. And property tax rates are capital gains on property is a lot of a higher rate. But as we mentioned quite a few times in this talk, there is potential that capital gains will increase going forward. So particularly this year, if you have got capital gains, it's maybe time to start having a chat, either with your current advisor or come speak to us, because you might want to offload those gains if capital gains rates get matched to income tax rates going forward. Then that could make it the tax position a lot worse for people moving forward. So yeah, definitely seek some advice, and yeah, have a chat to us if you think you're in that situation. Anything else to add, chaps, with capital gains or anything else?
I was just going to say, actually, on your GameStop investing and the huge losses that some people might have made, it's also worthwhile bearing in mind, if you have made any losses, that you can carry those losses forward against other gains you make in other investments, and you can do so indefinitely. So if you did have a bit of bad luck and time the market right at the top, don't worry, because I'm sure your portfolio managed through us would have made great strides forward over the course of the last year, so we can offset some of those profits against your GameStop losses.
Yeah, and as much as capital gains tax harvesting isn't going to make you a millionaire, I think it saves about 1,200 quid for a basic rate taxpayer and £2,400 for a high rate taxpayer. So if you're doing that every year, then yeah, considerable benefit over time.
Every little helps, I think they say.
Yeah,
other supermarkets are available.
Yeah.
Very good. Well, thanks for listening, and tune in next week. And if you've got any particular topics you want us to cover, or any comments from any of the content we've been making, then please let us know. Thanks very much.